We have an article here by Sebastian of Coinbase Asset Management. How does crypto perform in an inflationary recession? A pinch of paranoia is an essential ingredient in the risk management toolkit as markets hunt to humiliate hubris. Investors are tasked with monetizing megatrends. Macro risks are seen as a nuisance for growth-focused investment styles, but macro risks can and do derail poorly executed great ideas. So, recession odds should always be in the back of investors' minds. Our macro pulse by Coinbase Asset Management is built to bark when the risks of recession rise. Currently, it shows a rare mix of a recessionary economy and overheated prices. Woof woof. This isn't driven by a single factor like crude oil as in the past. Demand is being rationed by persistent inflation. When real interest rates were low, the private sector could borrow to smooth higher prices. But with higher real rates now, demand is contracting and economic nowcasts are falling sharply. Recession risk is rising. Crypto hasn't lived through many cycles, so there's no benchmark for how it will respond. There was the 2020 downturn and the near-miss recession after rapid rate hikes in 2022. The latter was far more damaging to crypto markets than the former. Why? Policy proactively eased to avoid a lasting downturn in 2020. When real rates were being reset higher, the flush of leverage led to a correlated decline in stocks, bonds, commodities, and crypto. Today is more like 2020 than 2022. Excess leverage was the story in 2022, and it prevailed across assets. That's what drove correlations, not structural factors. Now, rising real rates have curbed excessive risk-taking. Take crypto credit markets. Bitcoin mining saw a surge in rigs, a halving of rewards, and since March, sideways prices. Miners are now in capitulation. It's a rare event that signals that the market is resetting, a positive indicator for future Bitcoin prices. Last year's hiccup in the banking sector leans more to the 2020 lessons. The March 2023 crisis was short-lived and, well, hardly a crisis. Crawl, walk, and bank run happened in a short few days. Crypto assets were the first responders, dropping by roughly 20% due to banking uncertainty, yet fully recovering within 2 days. Disaster was averted with policy intervention, and investors flocked to assets like gold and Bitcoin. This is the playbook today. Policy rates have room to ease just by virtue of being higher than they have been for a long time. Don't ask me whether it is the right thing to do. Investors don't get paid to make that decision. Policy rarely seeks recession. Inflation has fallen sharply from its highs, and the risk of a downturn will raise confidence that pricing pressure will further ease. So, recession risk may be rising. Policy stands prepared to respond. The response is more relevant than the risk. Bonds were the perfect antidote for rising macro risks in the past, when real rates were high and inflation was falling. Bond prices rose sharply in the recession and didn't fall much in expansions, greatly improving portfolio characteristics. That's not the case in an inflationary recession with rising geopolitical risk. World central banks are sending an important signal, not only buying gold at a record pace at the expense of bonds, but also reshoring gold to domestic vaults. How does crypto perform in an inflationary recession? An all-weather asset akin to gold. In the 1970s, gold value rose more than tenfold. Despite painful recessions in the 1970s, where gold fell almost 50%, like in 1974, the asset provided protection that traditional ones could not. The S&P 500 remained largely unchanged in the decade, but a massive real devaluation given the doubling in consumer prices. Gold enhanced buying power for the next cycle. Investors are always seeking all-weather assets to protect against macro risks and let them survive growth risks germane to their portfolios. Bitcoin miners, option markets, dominance of large protocols, and the availability of leverage are all signaling a disciplined cycle, not a hype cycle. Real rates have room to decline as macro risks rise despite sticky inflation. Echoing the 1970s, commodities, including core crypto assets, are part of the all-weather wallet. End of article. So in summary, it's a well-written article. The author of the article, Sebastian, is making the case that there are similarities from the 1970s to what we might be seeing today. Also makes the case that crypto as a commodity, as an asset class, has not had and not been through many cycles previously. But having said that, there are some recent examples of what was happening in crypto in 2020 as the lockdowns began and the government printing presses were off to the races. And then what was happening in 2022 when there was really skyrocketing inflation and near imminent signs of a recession with multiple quarters of poorly performing numbers. So the article is saying that their market macro pulse, which is a proprietary tool of Coinbase Asset Management, they are showing right now there's a mix of recessionary economy and overheated prices, which is interesting to note from their tools. And now the argument of the article is that there's commodities. So the case study from the 1970s is that gold was the ultimate default and safe haven. And there was certainly a lot of inflation in the 1970s, and there's certainly been a lot of inflation in recent years. And the chart that they have in the article clearly demonstrates the amazing performance of gold over the course of that decade. But giving credit where credit is due to other asset classes, such as precious metals, and then also pointing out the clear fact that the asset class itself, Bitcoin, crypto, does not have many cycles under its belt. The author is walking a fine line and able to stay quite middle of the road in this article to make the case that Bitcoin, perhaps Ethereum, a few other key, large, outsized commodities within the asset class of digital assets are a good way to have a balanced portfolio, or as the author notes in this article, it's a good way to have an all-weather wallet. So that would certainly transcend not just retail investors, but I think in the case of Coinbase Asset Management, institutional investors and a lot of the larger B2B clients that are leaning on Coinbase Asset Management to give them the best sort of portfolio management and advice and consultation if they have the ability, or at least that mandate. So the article, we agree with nearly all of it. I think these are quite, if you've done the research and you're familiar with what they're reporting here, it is quite self-evident that there's going to be some really ugly economic headwinds that are affecting all asset classes, and there are cycles as well. So the author, it seems, is making the case that people could embrace copper or gold or other really recently well-performing assets of the commodities, but of course in this article making the case that Bitcoin, perhaps Ethereum, other really large market share of digital assets, these are going to be also great performers, perhaps in the short and midterm and maybe even long term, or at least through this next 2024-2025 crypto bull market cycle. So it's a well-written article. I think it's still very much quite sort of soft. It's not too sharply written because it's making a very much a middle of the road case, and it's not such a large ask for the readers to understand and embrace what the argument in this article is, and it's well written, and it makes a pretty clear point and a well written point. So hats off to the author for making the case, and it was a good article and pleasure to read, and looking forward to future articles.